Hello. It's a pleasure to engage with you today on a topic that, while uncomfortable, is crucial for every trader and investor navigating today's expansive global financial markets. Today's discussion is on the subject, Forex scamming. Forex scamming has become an alarmingly common issue in modern times, and understanding its mechanics is essential to safeguarding one's hard-earned capital. As a trader with extensive exposure to both the nuances and the pitfalls of currency trading, I believe I have a responsibility to share a comprehensive view of how scams operate, how they have evolved, and most importantly, how to shield oneself against them. In recent years, the Forex market's accessibility has exploded. Thanks to smartphones, social media, and easy online account setups, millions of new traders have entered the market without necessarily understanding the risks involved. Unfortunately, this expansion has created fertile ground for scammers to thrive. Unscrupulous individuals and shady organizations prey on the dreams of financial freedom, offering promises of impossible returns and secret trading formulas, ultimately trapping inexperienced traders into fraudulent schemes. Modern-day scammers have become increasingly sophisticated, using flashy websites, paid social media influencers, and fabricated testimonials to create an illusion of credibility. Historically, scams in financial markets are not new. Ponzi schemes have long lured investors with the promise of high returns with little or no risk. One of the earliest and most infamous examples is Charles Ponzi himself, who, in the 1920s, defrauded thousands by promising a 50% return on investments within 45 days through the trade of international reply coupons. More recently, the Bernie Madoff scandal shocked the world, exposing a multi-billion-dollar Ponzi operation under the guise of legitimate investment management. These historical schemes bear striking resemblance to today's Forex scams, only now the theater has moved online and the tools have become more persuasive. Escaping Forex scams requires vigilance, education, and a healthy dose of skepticism. One of the fundamental rules is that if it sounds too good to be true, it probably is. Promises of guaranteed profits, secret algorithms, or risk-free trading should immediately raise red flags. Authentic trading involves risk, discipline, and realistic expectations. Traders should always research the broker or platform they intend to use, checking for licensing and regulation by recognized authorities such as the U.S. Commodity Futures Trading Commission, the National Futures Association, the UK's Financial Conduct Authority, or Australia's ASIC. Regulated entities are required to adhere to strict financial standards and transparent practices, offering an additional layer of security to traders. Another critical pointer is to avoid giving full control of trading accounts to third parties without ironclad verification. Many scammers pose as account managers or signal providers, demanding deposit of funds and promising to trade on your behalf. In most cases, these managers either siphon the funds or trade recklessly to generate commissions. True education in Forex means learning to make decisions independently and retaining full control of your trading accounts. No legitimate advisor will ever guarantee results or request access to withdraw your money directly. Scammers today often use highly emotional tactics to trap victims. They may create a false sense of urgency, claiming that a once-in-a-lifetime opportunity is available only for a few hours. Others use the social proof method, showing fake success stories or doctored trading results to convince others to jump in. Recognizing these pressure tactics can significantly reduce one's susceptibility to fraud. A trader must always take the time to research and reflect before committing funds to any opportunity. When it comes to spotting a potential Forex scammer, there are several clear signs to watch out for. First, lack of transparency is a major warning. If a company or individual refuses to provide clear information about their location, registration, or leadership, they are most likely hiding something. Second, unusual payment methods, such as demanding cryptocurrency or untraceable wire transfers, are a hallmark of fraud. Third, overly aggressive marketing, often with luxury lifestyles, exotic cars, and glamorous lifestyles, can signal that the focus is more on luring investors than actual trading. Another significant point is the rise of unregulated brokers. Many of these firms register in offshore jurisdictions where oversight is minimal. They often offer high leverage and extremely attractive bonus structures that are banned in well-regulated markets. Once a client deposits funds, these brokers may manipulate prices, delay withdrawals, or simply disappear altogether. To combat this, traders must verify a broker's regulatory license by independently checking with the issuing regulatory body rather than relying on the broker's own website. Fortunately, there are regulatory structures in place designed to curb Forex scamming. Organizations like the CFTC and the NFA in the US, the FCA in the UK, and ESMA in Europe enforce strict guidelines to protect traders. They require that brokers segregate client funds from operating funds, conduct regular audits, and comply with fair advertising practices. Furthermore, these regulators maintain public databases where consumers can verify the status of a broker or financial advisor. Regulatory authorities also maintain fraud alert lists to warn the public about firms and individuals suspected of dishonest practices. Education plays a massive role in preventing Forex scams. Knowledgeable traders are far less likely to fall prey to get-rich-quick schemes. Reputable Forex educators, financial media outlets, and regulatory bodies frequently publish material on how to trade responsibly and avoid scams. Participating in trading forums, webinars, and courses offered by verified institutions provides a more solid foundation than any promises from unverified sources. Being part of an educated trading community also provides early warnings about scam activities circulating online. Social media has become a double-edged sword in the fight against Forex scams. On one hand, it has allowed scammers to reach wider audiences quickly. On the other, it has empowered legitimate traders to expose frauds faster. Various online communities and watchdog groups now exist that specialize in investigating and reporting scam operations. However, it is crucial to critically evaluate information and verify its credibility before acting, even when reading social media alerts. Another layer of protection involves the use of secure trading platforms. Traders should only use platforms that offer robust data encryption, two-factor authentication, and transparent trade reporting. Secure platforms protect not just from scamming, but also from cyber threats like hacking and identity theft. Due diligence in selecting a broker and a trading platform significantly enhances the overall security of a trader's operations. Lastly, emotional discipline is one of the most underrated defenses against Forex scams. Scammers rely heavily on psychological manipulation, targeting greed, fear, and impatience. Traders who stick to a disciplined plan, set realistic goals, and remain emotionally detached from hype are far less likely to become victims. Keeping emotions in check and treating Forex trading as a professional, methodical endeavor rather than a get-rich-quick adventure is crucial. I conclude on this note. History shows that scams will continue to evolve, but so too can our defenses against them. Always trade wisely while exercising ultimate vigilance. Thank you.